If you saw silver flash 88 on a screen and your first thought was, then why can't I actually buy it for that? You're not confused. You're seeing the crack between two worlds that the financial system desperately wants you to treat as one, because the number you call the silver price is often the price of a claim, not the price of metal moving into your possession. And when systems get stressed, when trust gets shaky, when supply tightens, when people stop wanting exposure and start wanting certainty, those two prices stop pretending they're the same. Here's the part most people miss. This isn't random. This isn't a temporary glitch. This isn't dealer greed. It's a mechanism. It's structural. It has rules. And once you understand those rules, you can predict the behavior before it happens. In fact, I'm going to give you a test right now. By the end of this video, you'll be able to look at any market, silver, gold, currency, even banking deposits, and ask one question that instantly tells you whether the price is real or just convenient. And I'm also going to show you the single moment where paper always wins, right up until the day it can't. But first, let me challenge you. If you believe there is always one true price in a system built on leverage and netting and settlement flexibility, then you'll hate this video. If you suspect even slightly that markets can be designed to produce a clean headline number while the real acquisition cost quietly detaches underneath, then you need to hear every word, because once you see it, you can't unsee it. And it won't just change how you look at silver, it will change how you look at the entire modern financial world. Here's the blunt claim. The widening gap between COMEX pricing and physical acquisition cost is the predictable output of a multi-stage machine that is optimized to keep claims liquid even when the underlying asset is not. That's not a conspiracy statement. That's an engineering statement. If you build a system where the easiest thing to trade is a promise, the system will trade promises more than reality. If you build a system where most participants don't require delivery, the price will be discovered where delivery is least demanded. And if you build a system where continuity of markets is more important than honoring redemption, then the system will protect continuity first. So let's make this simple. 4 stages. You'll see them in empire after empire, market after market, and once you know them, you'll start noticing the same signals before the crowd does. First stage, an anchor is installed. A system is built around a credible promise, convertibility, a peg, a delivery mechanism, a reserve asset, a contract structure that implies you can exchange paper for the real thing. The anchor creates trust. Second stage, claims expand. Once trust exists, the system grows by issuing layers of promises on top of the same base. Liquidity increases. Leverage becomes normal. People treat claims as if they are the asset. Third stage, stress arrives. It can be inflation, war, a banking panic, supply constraints, or just a psychological shift. The crucial feature is always the same. More people want settlement in reality, and fewer people are comfortable rolling paper claims. Fourth stage, the split. The system chooses to protect continuity of claims rather than honor unlimited redemption. And when that choice happens, you get bifurcation. The official quote stays on screens, while the real price emerges in premiums, delays, rationing, cash settlements, and that silent phrase that tells you everything, not available. Now here's the retention promise. I'm going to prove this pattern 3 times with history in a way that doesn't feel like school, because we're not collecting trivia. We're watching the machine run. Then we'll apply the exact same checklist to COMEX silver, and you'll understand precisely why the 88 is not the same thing as the real price. First proof, Bretton Woods and the gold convertibility break. The anchor was simple and powerful. Dollars were credible because official holders could convert them to gold at a fixed price. That promise created trust. The world piled into dollars. The dollar became the language of global trade. Then claims expanded. Trade grew. Deficits accumulated. Dollars spread worldwide. Banks created more dollar liabilities. Countries held more dollar reserves. The number of claims on U.S. gold grew far larger than the gold itself. At first, it looked like prosperity. It also created a silent truth. If too many people demanded the anchor at once, the system couldn't deliver. Then stress arrived. Confidence wobbled. Official holders questioned whether the conversion promise could really hold. The system tried to defend the anchor by suppressing the signal. It fed gold into the market to keep the official price credible, because admitting the price wanted to rise would have been admitting strain. And then the split happened. When the system can't maintain one clean official price and still satisfy real demand for the anchor, reality forces 2 tiers. A controlled official framework on one side, a more honest market price on the other, and eventually, convertibility ends. The anchor is removed to preserve the broader system of claims. That's the key lesson. When pushed, systems sacrifice redemption to preserve continuity. Second proof, Weimar Germany. the pure lab experiment of paper expansion meeting scarcity. The anchor here wasn't a formal convertibility promise. It was reality itself. Hard goods, foreign currency, limited production. You can't print coal, you can't print wheat, you can't print trust. Claims expanded anyway. The state printed to finance obligations. At first it worked because money illusion always buys time. People used the currency because yesterday it still functioned, and because life doesn't pause. Then stress became a stampede. Confidence snapped. People stopped holding claims. They spent instantly. Velocity went vertical. The real economy couldn't match the paper expansion, and the split became total. Official prices became theater. Real pricing moved to what cleared in goods, foreign currency, and hard assets. The true price became whatever the seller would accept in real terms. Again, same sequence. Anchor, expansion, stress, split. Third proof, U.S. gold controls in the 1930s, because this one teaches a brutal modern lesson. Even when the official price is managed, behavior still reveals the real price. Gold acted as the confidence anchor. Policymakers wanted reflation and liquidity, but were constrained by that anchor. Stress showed up as hoarding and bank instability. People wanted the anchor, not the claims. So the system changed the rules and redefined the official number. The quoted price became a policy input rather than a market-clearing truth. And once the public learns that official numbers can be administratively moved, they never forget. The posted number may remain clean. The real price leaks out through behavior, hoarding, scarcity, and alternative settlement. 3 different systems, same machine. So now when you ask, what does any of this have to do with silver? The answer is everything. Because COMEX silver pricing is not a pure physical clearing mechanism. It is a highly liquid claims market that uses delivery as credibility, not as the everyday final destination. And as long as most participants treat it that way, it functions beautifully. But that beauty is exactly the trap. Because the moment people want certainty instead of exposure, the system gets tested in the only way that matters. Can it settle in reality at scale? So let's run the 4-stage checklist on COMEX versus physical silver, step by step, like a forensic audit. The anchor today is the credibility of the contract system. COMEX is treated as the reference for the silver price. The contract is standardized. Delivery language exists. Warehouses exist. Clearing exists. The public hears delivery and assumes the price represents physical availability. That assumption is the anchor. It doesn't have to be perfect. It just has to be trusted enough to become the headline number. Then the claims expand. Futures exist to create liquidity and hedging efficiency. That's normal. But the consequence is unavoidable. You can create enormous silver exposure with minimal cash without moving a single ounce. One contract represents thousands of ounces. Institutions can control huge notional exposure. Most participants do not intend to take delivery. They intend to trade price changes, so the primary arena where the quote forms is a market optimized for trading claims, netting positions, and rolling exposure. Then you stack the modern layers on top. Unallocated accounts that function like deposits, ETF shares that represent exposure, swaps and forwards that replicate silver price behavior synthetically, and institutional structures that treat silver like a line in a portfolio. None of that is automatically evil. It's finance doing finance. It creates liquidity, it creates access, it creates volume. But it also multiplies claims faster than physical settlement capacity expands. And that's the moment the mechanism becomes visible. Here's the first major retention punch, and I want you to actually picture it. Imagine 2 silvers that share the same name but behave like different species. Silver A is exposure. You can buy it instantly. You can sell it instantly. It lives on screens. It's easy to leverage. It's easy to net. It's easy to roll. Silver B is custody. You have to source it. Someone has to fabricate it. Someone has to ship it. You have to take it into your possession. You can't net it away. Now ask yourself, when people get nervous, which silver do they actually want? That's the whole story. The market calls both of these silver and then acts shocked when they price differently under stress. Now we enter the 3rd stage, stress. Stress is not necessarily a crash. Stress is a shift in preference. Stress happens when enough people say, I don't want exposure, I want delivery. Or, I don't want a promise, I want the thing. That shift can come from inflation fear, banking instability, geopolitical tension, supply disruptions, industrial demand surges, or simply the realization that counterparty risk is not theoretical, it's lived. In calm times, the system runs on an assumption. Most participants will never demand the anchor. They'll trade claims and settle financially. In stressed times, that assumption weakens. More people want reality. And the system faces the same choice every historical system faces: honor unlimited redemption and force claims to shrink, or protect continuity of claims and make redemption harder. Here's the uncomfortable truth. Systems almost always protect continuity of claims because shrinking claims is politically and financially violent. Shrinking claims means forced liquidation, broken balance sheets, institutional failures, and public panic. So what does protecting claims look like in a metals market? This is the part where people look for a cartoon villain. Don't. It can look like perfectly legal friction. It looks like premiums rising even when the screen price falls. It looks like out-of-stock banners. It looks like longer delivery times. It looks like rationing and minimum order sizes. It looks like dealers widening spreads because they're protecting inventory. It looks like market structures nudging participants to roll contracts rather than take delivery. And it can look like cash settlement being treated as equivalent because cash settlement preserves the claim system without forcing physical movement. Now we reach the fourth stage, the split. You get two prices. The first is the screen price. The COMEX reference quote, formed in a liquid claims market where settlement is often netted, offset, rolled, and financially closed. The second is the acquisition price, what you must pay to obtain physical in the form you want, with the certainty you want, when you want it. In other words, the real price is not a philosophical debate. It's operational. It's what it costs to get metal delivered into your custody without relying on someone else's promise. So when someone says silver is $88 and someone else says, then why are coins and bars selling way above that? Both can be describing reality inside their own lane. One lane is claims. One lane is metal. But here's the key point most people miss. Under stress, the physical lane doesn't follow the screen lane. The screen lane follows liquidity and leverage. The physical lane follows inventory and trust. So you can be right about the screen quote and still be wrong about the outcome you wanted because you weren't buying what the quote represents. Now I'm going to address the biggest objection because this is where skeptics click away, and I want them to stay long enough to get the real point. They'll say, futures markets are designed to be cash settled or offset. Delivery isn't meant for everyone, so there's no problem. Correct. That's exactly why this matters. The mechanism is not COMEX is fake. The mechanism is that a claims market can dominate the headline price even when physical settlement becomes scarce. The system can be legitimate and still produce a quote that doesn't reflect the acquisition cost of metal during stress. Now here's the simplest thought experiment that destroys the illusion of one price. And I want you to answer it honestly, even if it makes you uncomfortable. If tomorrow, for 1 week, every long position holder was forced to choose delivery instead of selling or rolling, what would happen? If your answer is, no problem, the system would deliver to everyone at the quoted price, then the quote is a physical clearing price. If your answer is, there would be delays, rationing, rule changes, cash settlement incentives, and scramble behavior, then the quote is a claims clearing price with delivery as a credibility backstop, not as the daily reality. That's the whole game, not morality, structure. Now let's make this personal because engagement climbs when the viewer can locate themselves. There are two types of silver participants, even if they don't admit it. One participant wants liquidity. They want to trade the quote. They want to enter and exit quickly, adjust size, hedge, and treat silver as a financial instrument. For them, the screen price is the price because they're buying exposure. The other participant wants certainty. They want to remove counterparty risk. They want metal in custody. For them, the real price is what it takes to secure physical. And here's the tension that creates outrage. In normal times, these two worlds can pretend they're one. In stress times, they separate. And the separation feels like betrayal because people thought they were buying the same thing. This is why premiums aren't just greed. Premiums are the price of certainty and immediate availability under stress. Premiums are what the system charges when reality is scarce and claims are abundant. Now I'm going to open a loop that matters for the next stage because this is where the story gets dangerous. If bifurcation is real, what happens next? History shows bifurcation is often a transition stage, not a stable, permanent equilibrium. The system can tolerate a gap for a while, but the bigger the gap gets, the more the public notices. And once the public notices, behavior shifts. Demand becomes reflexive. People try to front-run the shortage by acquiring physical sooner. That, ironically, makes the shortage feel worse, even if supply hasn't changed dramatically, because trust and preference changed. That's why these episodes can accelerate. Not because metal disappears overnight, but because trust disappears faster than supply can respond. So what does the system do when pressure rises? It tries to keep the claims market functioning, always. It promotes liquidity. It emphasizes the ease of exposure. It normalizes cash settlement. It increases friction in physical channels. And it relies on the public's biggest weakness, believing the headline number is reality. But when that belief breaks, repricing can be violent, not necessarily in the screen quote first, but in availability, premiums, and settlement behavior. Reality usually speaks through shortages before it speaks through charts. Now let's land this with practical takeaways, because the viewer needs something they can actually apply. First, stop asking, what is the silver price? And start asking, what is the price of exposure and what is the price of certainty? Exposure price is what you pay to participate in price movement through claims. Certainty price is what you pay to remove counterparty risk by taking custody. In calm periods, they track each other. In stress periods, they diverge. And that divergence is not noise, it's the signal. Second, stop treating delivery stress like a rumor. Treat it like a structural indicator. Persistent premium elevation, persistent delays, persistent rationing, persistent substitution behavior, those are not random anecdotes. Those are stage 3 pressure leaking into the physical world. Third, know why you're in silver. If you're there to trade volatility, exposure might be fine for your goal. If you're there to hedge systemic risk, your hedge is not a quote, it's settlement. And settlement is not the screen print, it's custody. And now the final warning, because this is where people either wake up or they keep sleeping. This time is different is the phrase that gets people hurt. This time is different because America is exceptional. Debt math doesn't care. This time is different because markets are sophisticated. Sophistication often means more layers of claims, not fewer. This time is different because technology will save us. Technology speeds trading and leverage. It does not create ounces. It does not eliminate settlement risk. The pattern remains. Anchor, claim expansion, stress, split. If you understand this, you stop being shocked when the headline number doesn't buy you reality. You stop being manipulated by clean quotes during messy times, and you start seeing markets for what they are. Settlement systems, not just numbers. Now do something that helps retention on this channel and forces you to commit to a model. In the comments, write one word: exposure. If you mostly care about trading the screen quote, or certainty, if you mostly care about physical settlement. I read those comments, and it tells me exactly which next video you need. And if you want the next piece, how the machine was built, how the paper layers stack, where the pressure points sit, and what signals show up before the crowd sees them, subscribe and watch the next video. Because the next stage of the pattern isn't some distant apocalypse. It's simply the moment more people stop asking, what's the price? And start asking, can I actually settle it? And when that question spreads, the real price stops being a debate. It becomes the only price that matters.